Hey everyone, I'm Dan Matarrese from McKonly and Asbury, and we're happy to provide you this recap from a webinar we did on Tuesday, January 23rd, titled Tax Reform Legislation Analysis Part 2. For this webinar, I was joined by Mark Heath, who heads up our tax department here at M&A. We hope you enjoy this webinar recap, and please visit us online at www.macpas.com for more information about future webinars and our other events. All right, so one of the things we'll start with is, we talked about this a little bit in December, but what happened to my deductions? So there's a lot of changes on the individual side that pertain to personal deductions, and let's quickly just go through some of them. The first is personal exemptions are gone. So the dependency exemption that we would get for a qualifying child or qualifying relative are no longer part of our current income tax system starting in 2018. And we should specify this, Mark. This is not going to change any of the returns that us and our team members are going to be filing here over the next couple of months. This does not affect, again, 2017 returns. This is for 2018 returns and beyond.
But what if I prepaid my property taxes?
Well, if you prepaid your property taxes, there's potential that it could have offered you some benefit or prepaid some income taxes, and that would have helped you on your 2017 return because that benefit is going away in 18. That was a tough question to start off with there, Mark. I appreciate that.
But I thought they doubled our standard deduction. You're telling me all these deductions are going away.
They are. Let's get to it. So, again, personal exemptions are gone. State and local taxes are capped at $10,000 in total, including your real estate taxes. Mortgage interest is capped on only the first $750,000 of principal on your home. Charitable contributions are still there, and actually we've upped the amount that we're allowed to deduct. It's up to 60% of adjusted gross income. Miscellaneous itemized deductions like unreimbursed employee expenses, which if your employee would include business use of your home, tax preparer fees, investment expenses, those are gone. And we also did get rid of the overall phase out on itemized deductions, which will help people in that this phase out was taking away a portion of your total itemized deductions. That phase out is now gone.
So I've heard random stories about states offering tax credits in exchange for charitable contributions. How does that work?
Well, I think a lot of the higher income tax states were pretty upset about this change because they had seen they'd seen essentially that the federal deduction was somehow subsidizing the high state income taxes that they were charging. So now that the individuals are not getting any federal benefit for a lot of those higher state and local taxes paid, I think the states are eager to try to find a way to still give individuals a benefit from paying these taxes from a federal income tax perspective. I have not yet seen any true plans that were put in place, only some discussion. Mark, do you have some other information?
I don't have anything specific, but that's because there's no cap on charitable contributions deductions, but there is a cap on the state and local taxes. So I'm trying to drag Dan into a political debate. He won't bite. So.
I'm doing my best not to. All right. So again, those are kind of what happened to some of our personal deductions. So standard issue, not such a bad thing. This is what Mark just alluded to, that our standard deduction, while some of the other things we talked about are going away, our standard deduction is almost doubling in 2018. So married filing joint, $24,000, head of household, $18,000, single, $12,000, and then married filing separately, $12,000. This is the amount that the IRS just says you're allowed to deduct from your income in arriving at your taxable income just for being alive. You don't actually have to have any expenses. This is the amount that you are allowed to deduct. So again, that's the change. We've heard about this now. Hey, everyone's standard deduction is going up. The standard deduction is actually taken by the overwhelming majority of taxpayers in the U.S. That's somewhat of a distorted figure because it also includes children as far as the number of kids who actually pay taxes. But all things being equal, we do have most of the country utilizing the standard deduction. So let's look at a quick example. Our friend the Smiths, who are clearly a fictional family, they are married, they have 2 children, and they take the standard deduction. So in 2017, they had $28,900 of total deductions available to them. And that was comprised of $4,050 of personal exemptions times their 4 dependents, 4 meaning themselves, husband and wife, and 2 children, and $12,700 in standard deduction for married filing joint. Again, that was the married filing joint number in 2017. So $28,900 of deduction. In 2018, their total deduction is just the standard deduction of $24,000. So while deduction, the standard deduction has gone up, in this example, the overall family has less deduction in total, less that they can deduct in arriving at taxable income in 2018 than they did in 2017. Now, big caveat here. Let's not forget to consider the increased child tax credit or your overall drop in rates that you've had. So what I just described here does tell the story of the total deductions available to them, but it doesn't consider some other aspects of the tax law changes, which are the increased child tax credit or the drop in rates. So as you can see, it's not necessarily simple or straightforward, whereas, hey, standard deduction increase almost doubling means everybody's going to pay less tax. It depends on the specific situations of the individual. So before we go any further, let's jump into this before we talk about rates, because overall our rates have dropped quite a bit across the board. So a little background information first. What's a taxable base? Well, your taxable base is the amount of income that is subject to tax. So why is this important? Well, let's take Pennsylvania, for example. So, Mark, we live in the Commonwealth that quite frequently touts its very low personal income taxes.
That is true.
3.07%. Mm-hmm. However, PA has a very high taxable base in that you're not allowed essentially any deductions or exemptions. You can't get a deduction or deferral for amounts you put in a 401k on your PA return. So while PA has a low tax rate, it has a high taxable base. The interesting thing about
So it almost sounds like Pennsylvania has simplified the tax return. Is that an accurate statement?
I definitely think that would be an accurate statement that
weird.
They have simplified it.
Yeah.
Yes. So, excuse me. I think when we look at the different aspects of this bill, it becomes clear that we've had a lot of potential competing adjustments to taxable base, meaning some things that will force our taxable base to go up, some that will force our taxable base to go down. But across the board, we are seeing a decrease in tax rates for everyone. And as we just said, again, it cut rates across the board, but it did not necessarily decrease everybody's taxable base. So along those lines, being all about that base, no C Corp.
That's so bad.
I wish you guys could see Mark. He's not impressed with my attempt at comedy here. Let's then dig into this whole idea of the rates that we have or the taxable base that we have. C Corp rates went down. Mark is going to talk about this a little bit later, down to 21%, right, Mark?
That's correct. Federal, yes.
On the federal side, they're down to 21%. With the tax rates that we saw changing on the individual side, they did not have nearly the same drop. The individual side went down from 39.6 to 37 as the highest marginal rate. So the question then becomes, if nothing else was done other than that C Corp rate drop, we would probably be telling a lot of our clients to go become C corporations right now.
Yeah. Which, and we'll talk about that a little bit later on. But yeah, they had to do something on what we'll call the business taxes being paid by individuals, aka flow through structures. They had to do something with that to make it more competitive. So you're not just blindly paying more tax as a flow through than as a C corporation, because we all know what would happen. And I don't know if that's necessarily even a bad thing, but right. If we did just do away with all flow through taxes, it'd certainly simplify things. But that's neither here nor there for this conversation.
Yep. So in comes in this beautiful qualified business income deduction concept. You'll hear me use the words QBI a lot to talk about this. And what is QBI? Well, QBI It's a new deduction of 20% from the taxpayer's qualified business income. And again, we see this as a way to keep pass-through entities competitive. And what we mean competitive, as Mark alluded to, is there's always been a marginal benefit to the overall taxes paid. And this is a general statement across the board. Of course, there's specific situations where it may not be true, but there's always been a marginal benefit to being a pass-through entity from a tax perspective, meaning less taxes are paid on ongoing income reported and the access of cash being distributed to owners if you were a pass-through entity, an S corporation, or a partnership. With the rate drop on the C Corp side, it would have changed that drastically. So this 20% deduction, this qualifying business income deduction, I think evens the playing field in that now we still have a benefit to being a pass-through entity. It's actually not as large as it used to be, all things considered, but there's still a benefit to us being a pass-through entity when we think about the total taxes paid by the owners on the income passed through to them once cash is distributed as well. So QBI is as simple as ABC, right? Well, let's figure this out. So if you are the owner of a sole proprietorship, which reports income on a Schedule C, and if you have a rental activity that reports income on a Schedule E, if you own an S Corp, which you get a K1 from, or if you own a partnership, which you get a K1 from, you are going to now get an additional deduction on your personal return equal to 20% of the amount of income from the business activity that's reported on your personal return. We wish it was that simple, and we wish it stopped there, but it does not. So let's dig deeper into QBI, and as we say here, we're going to need more postcards. Mark didn't get this joke when I initially said it, so...
You're right, I did not.
Again, the whole idea of everyone's going to be able to file their return on a postcard, I think is especially laughable as it relates to this specific aspect of personal income taxes. So let's get some specifics of the QBI. So the deduction, 20% of qualified business income. There's actually a couple limitations we have to think about. One, it's the lesser of the 25% of qualified business income or 50% of the total W-2 wages paid by the business. So if you have a business that you own 50% of, and the total amount of wages that business pays to all employees is $200,000, your 50% of that for your ownership is $100,000, and your 50% of the total amount of your share of that $100,000 is $50,000. So that means you have to compare that figure to 20% of the qualified business income that flows through to you from that entity. That's the first limitation. There is an alternative limitation for entities that don't have wages that they pay that is equal to the owner's allocable share of 2.5% of the unadjusted basis of certain business assets. So, although not explicitly stated, Mark, I don't know if you agree, but this clearly is a way to have individuals who own, I don't know, let's say lots of real estate properties to be...
I hadn't even thought of that.
to be able to bear the benefit.
Well, but wait, all those real estate properties would be able to take the deduction because of all their W-2 wages, right?
Well, Mark, a lot of those real estate entities do not pay any W-2 wages. They don't have employees in the normal trade or business.
Interesting.
Very interesting. So, excuse me, this additional alternative limitation using basis in property is one way that individual businesses or businesses that don't have W-2 wages still may allow their owners to qualify for this deduction. A huge thing to point out here is that the 50% of wage limitation only applies if the taxable income of the business owner is over certain thresholds. Total taxable income, this is not just income from this activity. So if you're a married filing joint individual and your total taxable income is $315,000 or more, it actually phases out from $315,000 to $415,000, then you have to be concerned with this 50% limitation, 50% W-2 wages. If your income's below $315,000, you don't have to be concerned with this limitation of whether or not the entity actually is paying wages to individuals. So this would suggest that we're going to get some benefit to maybe pass-through owners of not hugely large pass-through entities, right? Mark, we're going to get some of that benefit. I think this is an important time to just point out, and this isn't meant to be a political comment, but nevertheless, 60% of all pass-through income reported on individual tax returns is reported by the 1% of all earners in our country. So I'm going to say that again. 60% of all pass-through income is reported on the returns of the top 1% of earners in all of our country. So this provision, this qualified business income provision, and actually any income provision that would benefit pass-through entities or pass-through shareholders or owners is actually going to concentrate it or be most concentrated in our highest earners. Now, that group is also the overwhelming large amount, or the overwhelmingly large proportion of our total tax collected comes from that group as well.
True.
So I'm not surprised that they would bear the most benefit from it. But a lot of times we talk about pass-through entities and we think about smaller businesses. And while most pass-through entities definitely are smaller businesses, overall, at a macro level, again, 60% of all income that is shown on individual returns from pass-through entities is at the top 1% of earners. All right, so again, just to regroup that bottom line, if you're married filing joint, your income is $315 or less, you don't have to worry about that additional exclusion. If it's over $315, then you start to have to worry about the 50% of W-2 wages or the 2.5% of unadjusted basis, and there's some additional complications there that you have to think about in the deduction. So, Mark, all pass-through income, no matter what the business is qualifying business income, right?
It sounds right. Yeah, sure.
Mark, we would say that is fake news. If taxable income is over the threshold amounts that we mentioned, like the $315,000 for married filing joint, then income from specified service businesses is no longer eligible for the deduction. I said this last time when we chatted in December, but where are the AICPA lobbyists in this?
Funny story. I was at a conference last week in Arizona, and I was speaking to a gentleman who's on the board of the AICPA. And I was giving him a hard time, and I said, hey, where were you guys? And he kind of lost it on me because he was so the board as a whole was so angry because they had lobbied so heavily for this and were just completely shut out. And it is striking because accountants and lawyers are the two biggest service businesses that this affects, and yet they weren't able to get this tax break that other companies are getting. And the only thing I can think of is that they have this image of accounting firms as just being, three people who otherwise would just be operating independently and decided to get under the same roof and do it, and they don't really have employees or anything else. But that's just simply not the case. But nonetheless, this is the position we're in.
Yeah, I think one of the things that's frustrating from my perspective, too, on some of these different provisions is we're choosing winners or losers in certain industries, right? We added this provision of if you don't have W-2 wages, you have 2.5% of your adjusted basis in the property, which clearly is then pulling in companies that don't necessarily have employees. But then we also have these provisions like service businesses, accountants, attorneys are somehow exempt from this additional deduction. It does make it seem like we don't have an equal playing field as it relates to who can bear the benefit of these new provisions.
One thing that I am a little bit concerned about is we don't really have a definition of specified service business yet, because presumably that's going to be included in the regs when they release those, but we don't have that yet. The only definition I've seen, at least from anything authoritative, was centered around the concept of any business that uses the personal goodwill and capital of the owners is qualified as a service business.
Can you say that again, Mark?
Any business where is centered around the personal goodwill and expertise of the owners is a service business. Can you think of a business that is not a decent chunk of which centered around the personal goodwill and expertise of the owners.
No.
That's a really big tent.
I mean, I think you get to a point maybe with some really large retail shops, right, where you would say eventually, the Matarrese family retail store, eventually down the road, the goodwill of the family is no longer involved, and it's not the owners. But Mark, just to your point, that's not the overwhelming majority of businesses in our country. There is definitely, I would say, a pretty good argument to say that we're not being logical in blanket disallowance for specified service businesses. So finally here, digging a little bit deeper into the QBI, we still haven't found what we're looking for. And yes, that is a reference to you two, and it was done intentionally.
I did get that.
Good. Mark got that one. Hey, guys, I'm like 1 for 3 on getting Mark to follow my jokes. I got to go back to the drawing board. It still remains unclear whether the specifics of the calculation of the QBI deduction will treat all pass-through entities equal. There's still some questions on whether S corporations, which not only do they have to have wages, but will the wages that are paid to the greater than 2% shareholders be part of the calculation? What will guaranteed payments to owners or partners in partnerships be treated for these limitations? So Tony Nitti, who's a great author, tax guy who writes frequently for Forbes, Tony released an article where he was interpreting originally that there would be some disproportionate treatment in different pass-through entities, and he got a lot of pushback from people who are not interpreting it the same way. I think again, it still remains to be seen whether we could be in a position where we're saying, hey, this type of pass-through entity makes a difference. All things being equal. There's still some things there that we'll have to wait for the IRS. To issue some regs.
Yeah, the good news is with all of this, there are a ton of planning opportunities that we know will come about here at some point. Once we get more specifics on the information, once we see how everything actually plays out, there is choice of entity is going to be a larger discussion than it ever has been. We're going to see more planning opportunities than anyone's ever seen before. That's what they tell me anyway. And
hey, there's 2 questions before we move on to some of the business stuff. There's 2 questions we're just going to tackle here. One was investment portfolio management fees were treated as miscellaneous deductions. Has that changed? No, it has not. So the ability to deduct that is gone. It's worth pointing out that those were subject to the 2% of AGI limitation previously, which means a lot of...
So you probably weren't getting a benefit anyway.
They weren't getting a benefit, and they were added back for AMT. So a lot of people who would have enough investment related fees to where it would matter usually have
probably
income,
an AMT.
Usually have income that either they were phased out for 2% or they were in AMT and deduction was not helpful. Another question came in that says, what if you're a 1% owner of a company? Are you limited to 1% of the 50% of wages as the cap? And it says, would that be compared to 1% of the 20% of QBI? Yes. So your QBI deduction is 20% of the amount of income that's reported to you. If you're a 1% owner, that's already the 1%. And then you would take total wages of the entity, times it by 50%, and then times your ownership percentage, which is the 1%. So you'd be comparing those two in that scenario and figuring out the amount of deduction you're entitled to.
And presumably, we haven't seen the forms yet, but presumably, well, it may not. I was going to say the K-1 that you get from a flow-through business will have... I was going to say it'll have lines on there that say what each of these items are, but as we found out with the 199 deduction, the old 199 deduction, this is the 199A deduction, Cap A deduction, in case anyone was wondering, because apparently they ran out of numbers. They have to use the same 199 over again. But the old 199, which was a manufacturing deduction, each you would just basically get a statement, which was very confusing, attached to your K-1 that said, here's the flow-through of this 199 deduction to you. So this new deduction, I'm guessing it'll probably be the same, where there'll be a line on your K-1 or on your statement that says, here's your 1% of income, which is what it always was. Here's your 1% of the 50% of wages. Here's your 1% of the 2.5% of the capital. Yep. Here's your 1.1% of... There's nothing else. Those are the only 2 things.
I think you got it, yeah.
Yeah, thank you.
Well, and so, Mark, you hit on that point. I think you're going to hit on this a little bit, too. But it is worth mentioning that for manufacturers, people who were seen as producing, companies that were seen as producing things in the U.S., the domestic production activities deduction has gone away. That was affording a 9% deduction to the pass-through entity owners. That's gone, replaced by the 20%. So let's say you were a manufacturing company. You're getting 11%. Assuming that you meet all the other thresholds, you're going to get an 11% benefit from this law because you had a 9% deduction already. You're going to a 20% deduction. The 9's going away, replaced by the 20. So, again, all things being equal, it's not going to be 20% for everyone. But let's say, for example, a distribution company, right, Mark, was not qualifying for the domestic production activities deduction previously.
Yep.
They will qualify for this QBI. It's a little bit more far-reaching. So they will have a newfound 20% deduction or a 20% decrease in the owner's ultimate tax liability.
See, across the board, everyone is better off. Manufacturers are just less better off than non-manufacturers.
Mark, I'm going to hand it over to you. Let you start digging into some of the business aspects, some of the key aspects on the business side of things.
Thank you, Dan. As everyone has been talking about, the biggest impact of all this, maybe not to individuals specifically, but to the overall state of business, state of taxes in the United States. C corporations, which if you just look at the number of companies, is rather small when you compare it to the flow through businesses. But anyway, but it does have much more income, obviously, when you think of all the public companies who have to be C corporations. Their flat tax rate is now 21%. So when you look at the law, you see I have a line in there. It says fiscal year filers must use a blended rate. If you read the law says this rate change takes effect in tax years beginning after December 31, 2017. Problem is when you write these laws in the middle of the night, you don't actually go back and look at the code to see how the code is going to mandate, because at the end of the day, the Internal Revenue Code is what you have to follow. The Internal Revenue Code says pretty much, I don't care when you say the rate's going to be effective. If you change tax rates, it's going to be effective on the day, on the first day of its effective date. So regardless of whether or not you say it's only effective for tax years, they're going to say, well, if the law says it's effective for tax years beginning after December 31, 2017, that means the effective date is January 1, 2018, which means on January 1, 2018, every single C corporation, regardless of year end, your rate magically dropped to 21%. So if you are a fiscal year end of June 30, you're going to have to say, well, I had 34 or 35%, which was the max corporate tax rate previously, for half the year, and I had 21% for the second half of the year. Fortunately, they don't make you divvy up your income between those 2 years. You can just take your total taxable income for the year, take that blended rate, boom, you have immediate tax deduction. So, and then after your next fiscal year, then beginning July 1, 2018, you'll have 21% for the whole year.
So, Mark, what you're saying is it doesn't necessarily seem like the simplified things.
You picked up on that theme? So, impact on financial reporting. When you're a C Corp, you have to book an income tax provision, income tax expense on your financial statements. So, and there's two pieces to that. There's your current provision and there's your deferred tax provision. Your deferred tax provision uses the tax rate that will be in effect later on when those deferred items will actually change. So the biggest one is usually depreciation, where we've taken accelerated depreciation for tax purposes, which means we have a deferred tax liability going forward. Well, congratulations. To the extent that you were able to accelerate any deductions, including depreciation, you're now getting a permanent tax break on any remaining deductions that you didn't take. So your deferred tax liability at the end of your December 31, 2017 year will drop by 13 percentage points. So because we know that any deferred liability or deferred asset sitting there at December 31, 2017, is going to turn when that tax rate is 21%. So you get a 13 or 14 point percentage rate drop depending on where your rate was before, either 34 or 35%. So be aware of that. The other piece is, and this is where the FASB got involved, which is kind of confusing how they got to the answer they got to. They said that if you have items, deferred taxes that are hitting equity, they're not hitting P&L, the change is not hitting P&L, it's hitting equity, you cannot take the effect of this rate change through equity. You have to take it through P&L. And then you say, okay, well, then I would have this piece stuck in equity that doesn't tie to my deferred taxes as they relate to this item. So the FASB said, yeah, you're right. You know what? That doesn't make sense. So, but instead of just saying, no, we're just we won't make it hit P&L. Now you have to hit P&L. You have to close out your retained earnings, and then you have to do a reclass from retained earnings back into OCI. So once again, not simplifying things. Moving on, the dividends received deduction. Since we're dropping the rate from 35% down to 21%, they did lower the dividends received deduction to make up for that. So if you dividends you get from companies where you own 20%, you used to get an 80% deduction. You're now getting a 65% deduction. For less than 20% ownership, you used to be getting a 70% deduction. You're now getting a 50% deduction. One thing where they did greatly simplify things on the C corporation side is AMT, alternative minimum tax for C corporations, is now gone. Yay! So then the next question was, well, I've paid all this AMT in the past. Banks were in a big position here because banks pay a lot of AMT. I have all these AMT credits. Well, if we're not going to have AMT tax going forward, how do I get these? So you now can use them to first offset your regular tax liability going forward. So next year you have $100,000 of regular tax liability of $200,000 of AMT credits. You can offset your regular income tax completely with $100,000 of it using AMT credit, and then you can get a refund of an additional 50% of the regular tax liability that you offset. So that's year one, and so then you say, okay, well then how do I get the rest of it back? You just keep doing that 50% thing every year until you either, one, run out of AMT credits, or in 2021, they're going to say any AMT credits they haven't used yet, you'll be able to just take a full refund for.
Mark, quick question. Is there a postcard that will help you figure out what you just said on the AMT side?
No. But maybe we could create one. Next issue, net operating losses. So you have net operating loss in 1 year. You have income the next year. You can just carry forward your net operating loss, offset your current year income, and we're good, right? Well, they're changing that a little bit. Previously, you could carry your NOLs back 2 years. Well, you had to carry them back 2 years unless you elected out, and then carry them forward 20 years. And you could offset 100% of your tax liability with NOLs, except, of course, for AMT, in which case you could only offset 90% of your income with NOLs, which would then kick you into alternative minimum taxable income. And you'd pay AMT, and then you get an AMT credit, you'd carry that forward, and now you can get a refund for that. But we're skipping through all that now, finally, and saying, okay, net operating losses generated in 2018 and going forward, you can now only offset 80% of your taxable income with those losses. But we're going to let you carry forward those NOLs indefinitely. So they don't expire, but there's no carryback, but they don't expire at all going forward.
So all the carryback provisions are done. So, I mean, essentially, if we ever had a client with an NOL, we had to either elect out of the carryback because it was mandatory, and then move forward. So there's just no more carryback. We're just going, hey, these are carried forward indefinitely.
Correct. Effective for 2018 losses and forward. So 2017 losses, if you have an NOL in 17, you can still carry that back.
Awesome.
And that's one, if you can carry it back, particularly because if you have a 2017 loss, if you carry that forward, you're only going to be offsetting. You're going to be offsetting income that's only being taxed at 21%. Whereas if you carry it back, you're going to be offsetting income that was being taxed at 34 or 35%.
That's right. And everything, to your point, Mark, when they had to calculate the potential cost or effect on deficit of every one of these provisions, what you just said, this changed the NOL. They're calculating based off of a rate of 21%. Not based off of a rate of the previous 35%.
Yeah, and that's exactly right. They didn't want companies generating losses in 2018 where income would only be taxed at 21%, and give them the ability to carry it back and offset income that was taxed at 35%. Next item. This only pertains to public companies. So if you're not public, you can tune out for a second. Key employee compensation, the rules call it excessive employee compensation. I don't really like them deciding what's excessive and what's not. But anyway, key employee compensation. Previously, public companies, any of the generally the top 4 or 5 executives, if their compensation was more than $1 million in a year, their W-2 compensation, anything in excess of $1 million was non-deductible for tax purposes. With one very large exception being incentive-based compensation. So they had some hoops you had to jump through, but as long as you followed the rules, you could pay whatever executives as much money as you wanted. As long as it met these incentive-based comp rules, you could deduct it. So going forward, they said, forget it, no more incentive-based comp exception. So public companies for 2018 and going forward, any compensation in excess of $1 million will be non-deductible for tax purposes. However, if you had a contract in place prior to, I think, the end of November, not the date of enactment of the law, but the end of November, if you had a contract in place before then, that will be grandfathered in unless you write a new contract or you substantially modify that existing contract.
So, Mark, when you talk about the exception that used to exist, I'm going to oversimplify it here, but help me if I'm thinking about it correctly. Base salary of executive is $750,000. They could have a long-term incentive deal where if certain stock measurements and profit goals are met, they could get $5 to $10 million of additional compensation. Depending if those met the requirements, that additional compensation was not subject to the limitation previously, correct?
Correct.
Okay.
Now, yes. Now it is. Stock options were the big, or have always been the big one. Stock options, as long as your plan is written appropriately, you would be able to get a deduction for it for tax purposes. But not anymore, unless you have a contract in place in November of 17. This next one is kind of interesting. I'm honestly not sure what the premise behind this was, but the feds decided they're going to limit deductions for business interest. Notice I said business interest. So if you have investment interest expense, that would not be subject to this limitation. It's only business interest expense. So make sure you document what your interest expense is for. The limit, it's limited to 30% of adjusted taxable income. And so you say, what is adjusted taxable income, Mark? Adjusted taxable income is taxable income that's been adjusted for depreciation, amortization, and depletion. So if you have a ton of depreciation expense and that's wiping out all your taxable income, you're going to say, oh, no, I can't deduct my interest expense. Yeah, you can. So we get to add back our depreciation expense before we determine our business interest deduction limitation. As you can see there, the calculation is done at the entity level. And I should also point out we're through the items that are specific only to C corporations. We are now on to items that apply to all corporations, or all businesses, I should say. And then at the end, we'll be talking about items that specifically relate to only flow-through organizations. So as we said, the calculation is done at the entity level. So S corporations, partnerships, et cetera, the calculation is done there. It's not like they flow through the interest expense and then the individual shareholder has to commingle all of their businesses and determine what their income or loss is and then determine what their business interest limitation is. It's done at the entity level, at the separate company level. And it only applies for 2018 through 2021, so I'm sure we'll set up lots of different processes to streamline this calculation, and then in 2022 we'll throw them out. As I said, it applies to only business interest, and if you are what the IRS considers, or I don't want to blame the IRS for any of this.
That's not fair to them.
It's not, write this down. I'm defending the IRS. They didn't write any of these rules, none of them. Yet, however, they're responsible for enforcing them. And, oh, by the way, none of them worked yesterday. So I hope nobody bothered trying to call the IRS for any information yesterday. Again, not the fault of the IRS, but what was that thing that went on yesterday? Oh, that's right, the government shutdown. There was no one working at the IRS answering the phone, so hopefully you didn't waste your time on hold for too long. But yeah, the Congress decided that $25 million, if you're a business with gross receipts of less than $25 million, you are a small business, and this business interest deduction does not apply to you. There are a couple other restrictions also that are beyond the scope of this course. As we discussed earlier, the domestic production activities deduction is gone in 2018. So that 9% deduction of your taxable income that manufacturing companies were getting, they are no longer getting. However, if you're a C Corp manufacturer, your rate dropped to 21%. So good for you. And if you are a flow-through manufacturer, you're getting your 20% QBI deduction. So hooray. These are we're now going into a list of fringe benefit things that were kind of thrown in there. I'm guessing, at midnight, the night they were trying to get this passed, they keep running these calculations to see how these things are going to affect the deficit, because they couldn't go over 1.5 trillion, or else they would need 60 votes to pass it. And we all know that wasn't going to happen. So I feel like they just started throwing stuff in there and punching a button on the machine to see what would come out at the end. And when it hit 1.5 trillion, they said, okay, everybody stop.
Mark, you ever checking out at the grocery store, and your bill is, or anywhere else, and your bill is less than what you need to get a coupon to work, where it's like, I got to spend at least $50 to get this money off.
True. Yeah.
And you're sitting there and you're like, I'll throw in anything to make this thing work at this point. That's kind of what I imagine happened. They ended up with whatever new version of candy no one was buying that's right by the checkout, just to throw in to make sure they could get this thing to work.
Yeah, I was just buying. I was shopping the other day, and they had some promotion thing going on that I wasn't even paying attention to. And when I got up to check out, the person was like, "If you spend $5 more, you'll save like $20." And I'm like, "You just told me to go pick out a shirt for $5, and you gave me $20 for it."
How about
I get to take the $20 and the shirt home.
Yeah.
Anyway,
how about just give me 10 off, and I don't have to buy anything else?
Yeah. Anyway, so entertainment expenses are now completely 100% non-deductible. So too bad, so sad. You take clients out to the ball game, you can no longer deduct that. Your sweet box. Well, some of those were mostly limited anyway. But yeah, anything that falls into the category of entertainment is now completely non-deductible.
Mark, do you think? Let's point out here. So country club fees, which were kind of probably something people group into this, were generally non-deductible for a long time. They were specifically stated as a non-deductible expense, right?
Correct.
So this marries up all the other types of entertainment expenses to kind of treat that the same way. Do you think this is going to have a big impact on behavior of entities? I mean, you're a business owner. You see a lot of clients, businesses and financials. Do you think that they're truly going to do things differently because we don't get the benefit of the deduction any longer?
No.
Okay.
So I don't think it's going to affect the entertainment industry at all.
Okay.
Although it's easy for me to say, I don't know. Mm-hmm. Maybe indirectly when companies say that, okay, their taxes went down to 21%, but then moving forward, their tax liabilities are inching up and up for whatever reason. And they say, well, we need to cut costs in other areas. What's the first place you cut? Sometimes it's going to be entertainment.
Yeah. I think there's definitely a sense of, because a lot of these lost deductions that you're going through now were grouped in with an overall pretty aggressive drop in rates, and the creation of the QBI deduction. I feel like most companies are not they're still going to be spending. They're still going to be paying less taxes than they were last year.
Yes.
So to them, the fact that a couple things are going up, to your point earlier, I don't see them changing behavior.
Right.
It's still going to seem like we got more cash in our pockets
Yeah.
than we did previously.
I agree. In relation to that, there's no more free lunch, everybody. I've always said that there's no such thing as a free lunch anyway, but now there's really no such thing as a free lunch. All meals are now only 50% deductible. So you go out to a business meeting and have lunch as part of that business meeting. Previously, you could deduct that entire lunch because it had a business purpose. It no longer matters whether or not it had a business purpose, so you don't have to pretend to talk about work when you're at lunch anymore, Dan. We can't deduct it anyway. We now we can only deduct 50%. So all meals across the board, 50%. You bring your folks are working crazy hours late at night. You're bringing dinner in for everybody for the convenience of the employer. Sorry, still now only 50% deductible.
So I remember I attended once this. I think it was for an insurance salesman or insurance professional association. I attended this kind of luncheon type thing, and they had some other guy speaking on tax tips. And I remember this guy actually said, if you are out to dinner with your family, and again, I should start with saying we don't condone this at all. But he said, if you are out to dinner with your family, just ask your waitress if she needs life insurance. And then no matter what she says, just write on the back of the receipt with your family out looking for prospects and the date. And that's a qualified business expense.
That is a good point. The stuff I brought up were kind of legitimate business lunches, but yeah, there's a whole slew of stuff out there that was by no stretch of the imagination legitimate.
And again, just to hit it home, Mark, you're saying they just go back into that 50% deductible aspect.
Yeah.
There, you can still get a benefit from it, but we're not going to play this game or go through the work of saying, was this a true business purpose lunch or was this just lunch with colleagues?
Right.
Yep.
So, and one thing to point out here is most companies there in their GL, they're going to have a meals and entertainment line. You now need to split out your meals and your entertainment. So that's going to be one just practical change that hopefully everybody does. Because you're now going to have to say, was it entertainment or was it a meal, and put them on separate line items.
And I imagine that if they don't already, different places and different groups in the hospitality side are going to have to break this out. So, for example, we can no longer bundle and pay for tickets to a box that includes a buffet and have it be all one fee to attend a game. We're just it's gonna have to be broken out so it can be accounted for appropriately.
Yeah. The other thing they did away with was a deduction for transportation fringe benefits. So you pay for parking for your employees, and it's not included in their income, but you deducted it. Well, the business can no longer deduct that, and this applies to transportation. Like parking at your office, if you're traveling, that's still deductible. These are fringe benefits that you're providing to your employees just for coming to work. Before you could deduct them, and the employee did not have to pick them up in income. Now you can't deduct them. The employee still doesn't have to pick it up in income, but you can't deduct it. And all of these things, you can deduct it if you include it in the employee's wages. But who wants to go down that road? Finally, you can no longer deduct local lobbying expenses. Before, lobbying was always one of those things where everyone just assumed that if it was a lobbying expense, it couldn't be deducted. Well, lobbying expenses for local jurisdictions, for local legislation, you could deduct before. You can't anymore. They're offering a credit for payments made to employees on family or medical leave. So it's more complicated than I'm putting out there. So it's one of those things where it exists. If and when you're paying an employee who's on FMLA, you should look at how much you're paying them and figure out if you can get a credit for this. It's not just your normal minimum FMLA payments. So, but if you're paying wages to an employee who's on FMLA, that is at least 50% of their normal wages, then you get a 12.5% credit for each of those wages. And it increases ratably. So if you're paying 75% of their normal wages, the 12.5% credit would go up a little bit. However, it's only in for 2018 and 2019. This just screams like somebody was like, I want a credit for FMLA or you won't get my vote. And they said, fine, but we're only doing it for 2 years. So
That person's probably up for re-election in 18. They only wanted it for the 1 year.
So again, the IRS is going to go through great lengths to be able to track and account for these things, and then in 2 years it'll go away.
Which brings you to the point of a lot of the other things that we talked about that we haven't mentioned. A lot of them are set to go away in 2026. So
Yes.
most all of these provisions are temporary by nature. They will sunset, similar to the Bush era tax cuts and some other things. So if nothing is done between now and 2026, for the most part, we revert back to what our tax system was in 2017.
Pretty much. The qualified rehabilitation credit for historical buildings. The 10% credit for those is gone. We're not going to go into any detail here. It's just people need to know this exists, and if it applies to you, ask more questions. The 20% credit, instead of getting it in year one, is now being phased in over 5 years. Here's another big one, pretty on par with the 21% rate deduction. 179 expense. So if you're taking 179, the maximum is now $1 million, and that gets phased out with CapEx over $2.5 million. So if you're putting more than $2.5 million of machinery in place, you're not going to be able to take that max $1 million 179 expense. And even better news, we don't have to wait for them to up these amounts every year. They're just automatically indexed for inflation. So next year it'll be your max is like 1.12735 million. And your CapEx will be like 2.58742 million. However, if you do start phasing out of 179, congratulations. We now have bonus depreciation 100%. And again, so, you might want to make sure that all of your fixed assets were placed in service on September 28th, 2017, as opposed to September 27th, 2017. Because if they were placed in service on September 28th, you can deduct the entire thing in year one. And that goes for 5 years. The other big change here, other than going from 50% to 100%, is that this applies to assets that are both new to the world and new to you. So you can buy a used machine and still take bonus depreciation on it. Previously, it had to be a brand new machine. Starting in 2022, the 100% starts getting phased out. Over a few years after that, it goes down to 180, 60, and so on until it goes to zero, and we just revert back to regular makers. And Pennsylvania, for Pennsylvania tax returns, you will get no bonus depreciation. So this is important to make sure that you maximize your 179 expense before you start hitting bonus, because PA allows 179 for C Corps. There are limitations for flow-throughs, but they allow 179 for C Corps. But for bonus depreciation, Pennsylvania said 100% bonus depreciation, we will not allow that deduction. The only way you're going to recover the basis of that property is when you sell it. Qualified improvement property. Previously, there were a whole bunch of different categories, whether you're a retailer or a restaurant, that impose different rules on whether or not it's 15-year or 39-year property. They removed those restrictions, so now it's all qualified improvement property, as long as it's to the interior portion of a building, isn't tied to an elevator. You can take that over 15 years instead of 39 years. Just simplifies that a little bit. And, however, this is a circular thing here that I'm about to say. Bonus depreciation removed the qualified improvement property from assets that are eligible for 100% bonus depreciation. However, then they said all property with a useful life of less than 20 years is available for bonus depreciation. So qualified improvement property, since it's down to 15-year, slips right back in under bonus depreciation.
Yep. So they basically said they're not going to specifically identify the qualified improvement property as an exception. They're just going to say based off the useful life, if it's under 20 years, it's eligible for bonus.
You got it. A couple other things here. Research and development expenses. Starting in 2022, To the extent that you have research and development expenses, and it's a very detailed definition of what qualifies, those must be capitalized and amortized over 5 years. You can no longer deduct those in year one. So that's an intangible asset that you're building there, and we're not going to let you deduct them when they're paid. Like-kind exchanges now apply only to real property. They are gone for personal property.
This is a big one on the auto side. I know even from talking to our people, companies that had a fleet of automobiles, whether they were trucks or even just passenger automobiles for executives or other salesmen, the like-kind exchange provisions were pretty much a nuisance administratively, bookkeeping for the organization and for the professional service side and the tax side. And I think we're pretty happy it's going away and that they simplified it. So now we're just dealing with like-kind exchange provisions when we're intentionally doing a like-kind exchange
Right.
with real estate, which is,
Yeah.
in my experience, that's the only time people have intentionally sought out like-kind exchange treatment is when we're actually exchanging real property.
Yeah, because like-kind exchange rules are mandatory if you meet the definition. Deduction for pass-through income. I'm just kidding. We're not going to go through all this again. One thing I did want to point out here is that the deduction at the individual level is taken from taxable income and not AGI. So it does not lower AGI, which is what a lot of your phase-out things are based on. So,
And the 199 deduction, domestic production activities deduction, formally did lower AGI. It was the deduction in arriving at AGI. So
Right.
that's a little bit of a change here. Yeah.
Yeah, a couple of other items here. S corporations, if you're converting to a C corporation within the next 2 years, you're going to get favorable treatment of post-conversion distributions. Previously, if you went from an S Corp to a C Corp, your any subsequent distributions were generally taxable as a dividend to you immediately, even though you had this built-up untaxed, undistributed or previously taxed undistributed income built up in the company that would just sit there until someday when you sold it. They're allowing you to at least partially treat some of the distributions as previously taxed income and not pick them up as dividends in year one. And partnership technical terminations are gone. Thank goodness. They were a real pain. So if you transfer of greater than 50% of ownership or value in the partnership, you no longer have to technically terminate the partnership and file 2 tax returns and worry about your methods and everything else. So now we enter the commercial part of the program. How can McKonly and Asbury help you with all of this stuff? Bunch of things on the business side. Forecasting, this 199A deduction, it's complicated. Are you going to get it? Are you going to get all 20% of it? We can help model that out for you. The business interest limitation. If you're highly leveraged right now for whatever reason, but you're not necessarily terribly profitable yet, you might be concerned about that. We can help you out with that. We can do fixed asset reviews. Now, it's generally, we're just looking at whether it's 39-year property or 15 or lower property. But with 100% bonus depreciation, that's a huge deal. If you're putting a few $100,000 in 39-year property that you could move to 5-year property, that is a huge benefit with 100% bonus depreciation, or just 39 to 15-year property. That's a big deal. We can help you out with that. What we talked about a little bit earlier, entity selection. C corporations are back in play. Before, the default was just S corporation. You're just going to be an S corporation as long as you could meet the rules. Now, you really need to look at this if say you're a very highly profitable S corporation, sole individual owner, and so your maximum tax rate's 37%. And as an individual, you can't deduct your state income taxes. As a C corporation, you can deduct your state income taxes.
Right.
So that's playing with the rate as well. Even with the 20% deduction, you're probably not getting down to that 21% rate, or probably nowhere even close.
Oh, I mean, I would say the other side of that too. An example is if you have an entity that may be profitable, so you're still paying taxes, but you're reinvesting all of that money right back into the business, and you're not worried, at least in this phase, about liquidating and getting profits out to shareholders. You know, again, the equation of why the 21% C Corp we still say is on par with the 37% on the S Corp side is the idea that on the pass-through entity side, you can take out the cash tax-free. On the C Corp side, you have a dividend after your corporate tax if you liquidate or distribute cash to your shareholders. But let's say your business plan is, other than salaries, we're not taking out $1 profit. We have to reinvest in the business. We have to buy new equipment. We're doing expansion. There's definitely a lot of scenarios, to your point, Mark, that warrant us looking at it and saying is the right solution to flip that switch.
Yeah, the most important thing is modeling it out, because you got to think short term, cash taxes now versus long term. Obviously, long term answer from a tax standpoint is almost always going to be better for an S corp because you build up your basis in your stock. But you got to weigh it out. You got to say, well, what's our short term benefit? What's our long term benefit? Make sure you do that. If you have a profitable S corp with 30 shareholders, so you have all this income being split 30 different ways, maybe no one is getting to a tax rate that's above 25, 28%, something like that. And so you don't need to worry about it. But the important thing is to look at it to make sure that you're doing the best thing for you and your business.
Well, one of the other questions that came in, Mark, I'll punt this one over to you. Can pre-2018 losses offset more than the 80% carried forward? So my hunch is the question is, we're carrying forward NOLs from before 2018. Are they still subject to that 80% limitation on the 18 return going forward?
No, they are not. You can deduct, for pre-18 losses, you can deduct all taxable income going forward. It's not subject to that 80% limitation. And one other thing from a financial reporting aspect that I didn't talk about, if you have valuation allowance on your NOLs because you couldn't prove that you were going to be using them before the 20-year expiration, that valuation allowance may go away going forward because you may have more losses that will never expire, et cetera, et cetera. So just another thing to consider.
Thank you once again for joining us for this webinar recap produced by McKonly and Asbury. We hope you join us for our future webinars. You can stay connected to us and learn more about all of our upcoming events by visiting www.macpas.com. Thanks again and have a great day.